Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining me is Chris Engelbert, founding partner and CIO of Engelbert Financial Advisors, to discuss what retail investors are showing interest in and why RIAs should use separately managed accounts or SMAs in the course of their practice. Chris, it's great to see you as always. Welcome back to Trade Talks.
Yes, you too, Jill. Great to see you as well.
And Chris, you're noticing that retail investors are extremely interested in holding individual stock names, and which is a bit counterintuitive to what an advisor might want to hear when you're always talking about diversification and not so much concentration in one area or the other.
Yeah, Jill, really what's happened is we've seen an acceleration of the trend from 2020. Obviously last year, at this time, the whole situation started with the lockdown, people staying at home, et cetera. And so really what happened is the work from home trade stocks were mentioned over and over and over again. And again, when any of these stocks that I mentioned are not a recommendation to buy or sell, but people saw Zoom, Peloton, Amazon, Teladoc, they saw those stocks really, take off. And it really, to me, kind of sparked a rebirth for individuals wanting to talk about what's going on out there. And most recently in the news, there's been a couple of companies that had huge short interest that exploded. And I'm literally getting, one or two calls a day from clients going, hey, what do I own? Now, in our practice, we run portfolios with individual stocks in it. And we also use separately managed accounts. But the retail investor is really, like I said, I call 2021 the renaissance of the individual stock idea. They like to talk about it. They like to know, what they have. They're very excited about the new technology, whether it's electric vehicles or biotech companies or new software, cloud stocks, et cetera. I'm seeing something that I literally haven't seen in probably 10, 15 years.
And Chris, why do RIAs need to add separately managed accounts or SMAs to their client strategies?
Yeah, I think they have to do it. Otherwise, they're going to lose their clients. Now, there's two different businesses when you're an RIA. There's a business of investing people's money, and then there's the business of running your business. And what I think a lot of RIAs got, a little lackadaisical with the last couple of years is it's very easy to create a homogenized ETF portfolio, slap clients in these, these models. And clients are beginning to push back. They understand, that, if you're in an ETF that has 500 stocks in it, there's going to be a lot of dilution in it. Now, we've always in our practice, use either third-party money managers for separately managed accounts or run, individual portfolios ourselves. But, I come from a background where, from an institutional standpoint, where separately managed accounts are extremely popular in the institutional world. So, there's a lot of RIAs out there and that I don't know if they don't want to do the due diligence or take the time, but there's a lot of very good third-party money managers that are running separately managed accounts. And all of the major platforms, whether it's Fidelity or now Schwab, TD Ameritrade, have separately managed account models that are run by third-party managers that would be very easy for these RIA firms to integrate in their practice. And we think they need to do it because people like to get online. They like to look at their accounts. Oh, gee, I happen to own XYZ stock or whatever the case may be. Again, there's, I think, a real trend reversal happening here in the near term.
Let's take a look at some of the charts. We'll start with the S&P 500, and it looks like we have some choppiness that's returned to the market. We haven't spoken about that much since the February, March volatility back in 2020.
Yeah, now my theme is, 2021 is the year of return to normal for both the economy, the U.S. economy, but also the U.S. stock markets. And one of the things that we're trying to say to people is that last year was a very abnormal year. Big downdraft, big, long, nice recovery. But it's not unusual to have one or two pullbacks of greater than 10% per year. Now, the S&P went on to make new highs so far this year. We've had a pullback, but I think you're right. I'm not looking for a major pullback. Obviously, like we had, last year at this time, but this choppiness could really, extend for the next couple of months as people want to see what the economy is going to look like when it opens up again.
Right, Chris, and we're also seeing that reflective in the NASDAQ 100 as well.
Yeah, now the NASDAQ was a huge leader last year. It started out the gates really well. If you notice, some of those NASDAQ leader stocks have actually corrected 15 to 20% from their highs. The other thing that we've seen is we've seen a vicious rotation And it has to do a lot with interest rates, but a vicious rotation from large cap growth to value. And I mean, you and I have been talking about this for about a year, and we really started to kind of see a stealth rally in value stocks, i.e. the banks, and also energy companies. Well, it just exploded in the last 6 weeks. And, we actually think it's a trend that could continue. But, if the U.S. economy maybe in the third quarter starts to slow down or lag a little bit, I would not be surprised to see the growth area come back and have one more song. Let's put it that way. So,
and let's take a look at the Russell 2000. Certainly a different chart than the NASDAQ 100.
Yeah, you and I have been talking about this, last fall, and we we're like, hey, when are small mid-cap stocks going to join the party? They joined the party with a vengeance in December and January. They really turned on. I really think, and you and I talked about this last year, and we said, that the Russell 2000 and small mid-cap stocks could be the best performer for 2021, and so far they are. I think as the economy opens up, just like last year, where big stocks, big companies were able to pivot, get laptops out to people, create, work from home environments. Small companies lagged really badly because they couldn't do that. You had this bifurcated market. Well, now once the economy opens up and small businesses, see a resurgence, that money is going to go right to the bottom line.
And of course, let's take a look at energy. Another one of those areas, like you had mentioned before, finance and energy have the past 6 weeks, it's showing up.
Yeah, we show a long-term chart again this month. We showed it last month. We're approaching that downtrend line. Now, obviously, we feel, we have clients and we have a lot of friends that live down in Texas, and they went through a horrible situation the last couple of weeks. Some of the stories I heard were unbelievable. But, you basically shut down the energy hub of the United States for probably another good 3 to 4 weeks till it gets back on its feet. You got some supply constraints there. But again, we also think that the energy market is telling you the economy is opening up and we're seeing a resurgence. I would not be surprised to see, some kind of moderation in this run. But I do think the surprise is that you have higher energy prices for 2021, and it looks like they're here to stay.
All right, let's wrap up with the 10-year. Of course, that really has been the story this week.
Yeah, we've been very bearish on interest rates the last 4 or 5 months. Again, we feel that this is the economy opening up trade. I mean, when interest rates on the 10-year hit 0.5%, they were obviously much too low. I think what's really kind of unsettled the U.S. equity markets this week is how quickly interest rates backed up. And I mean, they backed up to 1.5% literally within a couple of days. We're probably near the end of this move at this particular time. Maybe we go a little bit higher, but again, interest rates are going to be a key for 2021. If you talk to anybody in the housing market, it may not be bad that interest rates have gone up a little bit to moderate, the mortgage refinances and the home sales. But, we're still worried that, the inflation trade is there, that the 10-year Treasury only 18 months ago was over 2.5%. It would not be unusual to see it continue to float higher. But we think near term, it's probably had a good run for the next couple of months. So.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.